We can't time the market. We don't know what's going to happen. Our goal is to be the best operators out there and to focus on cash flow and to have a plan and to not run out of money, to keep some liquidity, which we have, and be responsible deployers of capital. A lot of my investors have reached out recently, and Bolt Storage, as you know, we bought $50 million of storage. We actually raised for a little bit more in 2021. That's going to close here coming up early in 2022. We have over 200 active investors who have placed capital with Bolt Storage, and we are getting a lot of people reaching out. I've had a lot of my investors reach out to me and say, hey, Nick, a little bit of craziness in the market. The Fed says they're going to raise interest rates. Where's your head at? What do you think? Where's the risk in Bolt Storage? And where do you feel the industry's headed over the next 12 to 18 months? The short answer is that I have no idea. I don't know where the real estate market is headed over the next 12 to 18 months. I'm fairly confident I know where the real estate market, or at least my asset class, what I'm doing, Bolt Storage, self-storage, is headed over the next 10 years. So the short answer is, I'm not sure. I'm going to lay out a couple scenarios, but I will tell you that we are focused on managing risk. My investors don't pay me to be speculative. They don't pay me to be bullish. They don't pay me to think that everything goes up and up and up. My investors pay me to manage self-storage assets really well and to make sure that we don't lose their money, that the downside's protected. And if the self-storage tailwinds take off, we ride those waves. Maybe I generate some alpha. I think I can generate alpha by doing a better job than most operators. But generally speaking, I don't know. Over the next 12 to 18 months, the Federal Reserve has said that they're going to raise rates. And I see this playing out one of two ways. Now, the best case scenario, and if I had to logically put a probability on this, I would say 60 to 70%. The 60-70% case is that interest rates go up 100 basis points. So instead of borrowing at 3.6 or 4% right now, which we borrow at 4.6, 5% in a year or 18 months. Inflation continues to run. And inflation is good for us because we can raise rents, which we do, which we have been. We bought a place, 2 properties, one in Akron, Ohio, one in Georgia, North Georgia, and we are already hitting our 25-month pro forma on revenue 2 months in to the acquisition. We went from $42,000 a month to $65,000 a month at the North Georgia property, from $23,000 a month to $35,000 a month in the Ohio property. Not only that, but they were charging $60 for a 10 by 10 when we acquired the asset in North Georgia. We are now charging, after acquisition, we were charging $99 for a 10 by 10 unit. We rented 10 units in the past 2 weeks at $129 in this North Georgia market. Rents are going up. Our ability to change rents month to month is very, very valuable to us. So in the light inflationary environment, I think bankers still lend on self-storage. I think investors still chase after self-storage because of some of these other factors that make self-storage a resilient to inflation business. And we run, and things go well, and it's business as usual. That's a little bit more expensive, but we're still paying similar cap rates, and NOI growth continues, and business goes really well for us. Now, the bear case scenario, which honestly I spend a lot more time thinking about, is that interest rates go up more, 200 to 400 basis points. So instead of borrowing at 4%, we're borrowing at 6 to 8% interest. And at this point, we see some pain. At this point, we see some fear around commercial real estate come into play from bankers and investors. Cap rates widen, meaning instead of buying at a 4 cap, we're buying at 6 caps. values decrease, which that means values are lower. So if you have short-term bridge debt, variable interest rate, I'm not as worried about interest rates because interest rate risk is manageable because we have high debt yields, we have a lot of cash flow. I'm worried about term risk, meaning if my loans expire, I have nowhere to go because my properties are worth less and banks aren't excited, and that's where I can be in a real pickle. So in this scenario, I think we see some pain and we see values plummet for commercial real estate. This is when Bolt Storage will turn on the afterburners. This is what would be a perfect storm for us to acquire as much storage as possible. We have equity partners ready to go. We have the operations team that has been growing and becoming a well-oiled machine. We have 38 employees now, more on the way. And frankly, we get after it. We buy as much storage as possible during that dip because, again, 10 years from now, we're at the same place. So I'm focusing right now, Q1 of 2022, I'm focusing on securing longer-term debt. We have some 3-year terms loans that we have about 26, 24 months left on them. 24 months is a long time for me to work on securing debt, but I do not want to push it to 6 months to go to start thinking about it. So I'm going to start securing some longer term. I'm going to start locking in some interest rates. And I think that'll keep us in a good spot. Now, a big dip, you never root for a big dip in commercial real estate to happen. And right now, the last 6 months, we've been paying top dollar for assets. They're performing. We're hitting our targets. Our yield is better than expected, but we've been paying top dollar. We had an option to either sit out for the last 6 months or the last year, because 2 years ago, they were saying that self-storage was at an all-time high, commercial real estate was at an all-time high. We could be buying the top. Many investors sat out. Many investors did not buy storage. Many investors have not deployed capital. They've missed out on the greatest 2 years of rent increases and, frankly, inflation and what that has done to the values of our properties ever in the history of, well, as long as I've been doing this for sure. But I do a lot of studying of historical events, and this has been a pretty unique 24-month period. So, with that being said, you cannot time the market. I cannot time the market. Our investors cannot time the market. What we are doing at Bolt Storage is dollar cost averaging into a healthy cash flowing portfolio. We're focusing on cash flow. We're protecting our downside. We're using a lot of equity, often 45% of the total cost of a deal. Equity, that's what we're doing right now. 60% LTV loans after closing costs, fees, upgrades, capital improvements. We're looking at about 55% loan to cost, 52% loan to cost. That's a lot of equity. That's a high debt yield. Debt yield's over 8%, over 9%, meaning we can take a 7-8% interest rate before we're cash flow negative. So I think we're in a good situation. Now, if that second scenario happens, that 20 to 30 to 40% probability case where we see some pain, of course we'll miss projections. Of course our yield won't be where we want it to be. Interest rates will go up. Of course our value will drop for a while. But most of the people on our team, me included, I am playing a 10-year game. I don't care what our self-storage facilities are worth a year from now. I don't care what they're worth 2 years from now. I don't necessarily even care if we hit our projections over the next 12 months. I care about the 12-month, 12-year, 10-year, 12-year, 15-year trajectory of our business. And I've never been more confident in that it's a good business, that we're going to see a lot of tailwinds, and that we're going to build a healthy portfolio. So our goal is to dollar cost average into self-storage over the next 10 years. We're going to buy $100 million a year of self-storage over the next 10 years. Some years we'll buy it more expensive than others. And if there's a dip, we'll buy it at a more value. We can't time the market. We don't know what's going to happen. Our goal is to be the best operators out there and to focus on cash flow and to have a plan and to not run out of money, to keep some liquidity, which we have, and be responsible deployers of capital. Not all of our investors want self-storage exposure right now, but the ones that do, we're going to deploy that capital. We're going to take what the market gives us and we're going to buy storage. And then we're going to operate it really well. Some people are going to wait until things cool off and then they want to invest. That's great too. we're going to take what the market gives us. People ask me all the time, what are your goals? How much storage do you want to buy? Where's Bolt Storage going to be a year from now? It's easy for me to say I'm going to buy $100 million. It's easy for me to say we're going to grow X, Y, Z, this many employees. I'm guessing. I'm shooting from the hip. I don't really have goals. We're going to take what the market gives us. We are prepared. We're building a team that can probably buy $150 to $200 million worth of storage in the next 12 months. Will that happen? I don't know. We'll take what the market gives us. We are going to do good deals. We're going to protect the downside, and we're going to operate really well. That's all that I can say. I don't know what's going to happen. Neither do you. But whatever's thrown at us, we'll adjust, and we'll try to survive, and we'll do our best.
Juniper Square, the sponsor of our show, recently did a capital raising survey. And in this survey, they asked 142 senior executives at US-based commercial real estate firms a series of questions to understand the state of commercial real estate fundraising. It's an insanely valuable report with data on questions like, how much capital did you raise last year? How long did your last raise take? What type of investors are you raising the most from? And what strategies are working the best for you to find new investors? Download this report for free at junipersquareresearch.com. That's junipersquareresearch.com. Big thank you to Juniper Square for sponsoring the show. Thank you for listening to The Nick Huber Show. Just wanted to remind you that we have a paid real estate community where some really special stuff is happening. People are breaking down deals. People are networking. People are, I think, even formulating partnerships inside this group. We have over 100 members now. For more information, you can visit sweatystartup.com/REC. And the first 299 members of the group to get some momentum get $200 off the annual membership using the code FIRST299, FIRST 299. And also, you can check it out for 5 days for $1. You make a $1 payment, you can check out the community for 5 days. Highly recommend it if you're serious about bringing in some other people into your network, into your life, to help you become a better real estate investor.